Join us now, the Earnings Scout co-founder and CEO Nick Rach. From what we've seen so far and what you're expecting, Nick, are we in a 5% GDP economy, or are we in an economy that's going to be in a recession by the end of the year? I mean, which is it? How can we have both, reasonable people, one saying one thing, one saying the other? How can that be? I guess that's the uncertainty David Solomon was just talking about.
Right. Well, parts of the economy have been rolling, but most of it has not. And we're not behaving at all like we're in a 5% economy. To be honest, if we did go into a 5% economy, that probably means the Fed's going to keep interest rates higher for longer, which could take a toll on earnings expectations. And then for the first time in a year, we're actually measuring estimate trends for the S&P 500 start to weaken on a rate of change basis. And the market's been sniffing that out now for really since August 1st. And we're just starting to measure that now.
Have you heard, Nick, that big tech is the new defensive place to be?
It has been. And really, looking at earnings trends, and all the Magnificent Seven have had some of the best earnings momentum there is within the economy. So AI is booming, and that's done very well. But other parts of the economy are starting to take a hit, and particularly this rise in commodity prices that we've seen since the end of May and the spike in rates. Is definitely starting to wear on the earnings, and we're seeing it in the early reporters.
So who will miss? What groups will miss or have downbeat outlooks?
Well, the one that's going to do better, but I think it's temporary, is going to be the energy sector. That's kind of in the crosshairs of what the Fed's trying to do. I don't know how we can have a sustainable bull market right now and have energy prices soaring. It sort of defeats the purpose of what the Fed is trying to do. Tech and communication services should continue to do well, but the areas that will be weaker could still be the financials. I know the yield curve's uninverting, which should help them a little bit, but this spike in rates could take a toll on the economy. You might see those start to be necessarily underweighted. What
about anything housing related? We just had Pulte on. They managed to beat expectations in this quarter, or anything related, Home Depot, Lowe's, cyclical type.
Right. Mortgage rates at 20-year highs. So one thing, out of all the early reporters that have come in, and by the opening bell today, there'll be 117 S&P 500 companies that have reported. The number one best revisions have come from Lennar. If you would believe it, if the earnings estimates were raised 11% after reporting, and the stock's down 21% over the last 3 months. And the reason is, even though the estimates went up 11%, the best we've seen in the S&P 500, in the prior quarter, the estimates were going up a rate of 30%. So the positive momentum is slowing as the rise in interest rates start to take a hit on some of the home builders.
So what is a barbell in retail? We just said something about, you got a Birkin bag?
No.
You know what a Birkin bag is? You got one?
I don't have one.
Do I have a Birkin bag? I very much know what a Birkin bag is.
I know you know what one is, but so they're hot. I don't know about middle, and then you figure if inflation's bad, then the dollar stores do well. So is it like what's going on in retail? Is it barbell?
The market of haves and have-nots. That's a great way to put it. It's a very strange year where the S&P 500 is up 10%, yet 58% of the stocks in the S&P 500 have negative year-to-date returns. So within consumer, it's certainly to describe the market of haves and have-nots is the best way I can put it.